Welcome back. In this session, I'd like to talk about Paytm. In fact, let me set the stage. A few weeks ago, I valued Zomato, the Indian online food delivery company. Now, I won't go into that valuation. You can find it online. But the stock went public and doubled in price very quickly. It's done really well, and it reflects the appetite for Indian investors for young growth companies, even those that are losing money but have growth potential. Now, the next big company coming down the pike, perhaps the biggest of the year, is Paytm. Paytm is a company that has taken advantage of the growth in the smartphone in India to essentially dominate the online payment market. And in this session, I'd like to talk about the drivers of Paytm's value and what might induce you or not induce you to be an investor in its IPO. So let's set the stage. A decade ago, going back to 2010, less than 3% of Indians had smartphones. For a couple of reasons. One, they were incredibly expensive. There was really not much you could get in terms of cell service. So primarily affluent Indians living in urban areas had smartphones. Well, how things have changed. Over the last decade, hundreds of millions of Indians have acquired smartphones, and two factors have played a role in the rise of smartphones in India. One is the entry of Chinese companies offering smartphones at much lower prices. It's made smartphones affordable to Indians. And the second is Reliance Jio offering a service to the Indian market where cell service was offered at far lower cost than before, often for free, bringing in hundreds of millions of Indians into this market. So with those two forces, by the time you get to 2020, there are more than 500 million smartphones in India. Now, as the number of smartphones have increased, so has their usage. In fact, in a 2020 survey of how many hours people spend on their smartphones, Indians came in third. I'm not sure this is a contest you want to win, but in 2020, after Indonesia and Brazil, Indians were the third largest users of smartphones, spending 4.6 hours per day. Now, why do Indians spend so much more time on smartphones than Europeans and Americans? Well, part of the reason is this might be the only device that most Indians have to connect to the internet. It's not a question of, do I use my smartphone or my iPad or my computer? It might be the only device. So the number of phones has increased, the usage has gone up, and not surprisingly, Indians are finding different and novel ways of using their smartphones to connect online. In particular, you're seeing the rise of the use of the phone to make payments. Now, if you look at these graphs, they graph out how much mobile payments have risen just over the last 2 or 3 years. And clearly, COVID has made that surge even greater as more and more Indians start to use their phones to make payments for goods and services. Here again, there is an external force that's pushing this trend forward. And that was the introduction in 2016 of UPI, United Payments Interface, a real-time payment interface devised by the National Payment Corporation of India and regulated by the Reserve Bank of India, which allows for people to transfer money quickly and at low cost across people and to merchants. Now, as you've seen the rise of the smartphone, its usage in mobile payments, you've also seen the rise of Paytm. In fact, the history of Paytm is very closely tied to the rise of the smartphone in India. Paytm was founded in 2010. Vijay Sharma, when he founded it, had pretty small ambitions. He wanted to create a prepaid mobile platform, but its market then was small because the number of people who had mobiles was small. Now, as mobile access has improved, Paytm has added to the list of products and services. In fact, in almost every year of its existence, Paytm has added a new service, a new product to its existing suite. In 2014, it introduced Paytm Wallet, a digital wallet where you could keep money and essentially use it to pay for goods and services. In 2016, it added ticket bookings to movies and events and amusement parks. Flight bookings came thereafter. It also introduced Paytm Mall. And when you look at the owners of Paytm, you're not going to be surprised to see Alibaba show up there, because Paytm Mall, in a sense, replicates what Alibaba has succeeded with in China with the Taobao Mall. In 2017, it added Paytm Gold, taking advantage of Indians' attraction to gold and allowing them to use small quantities of gold using the Paytm platform. It introduced a Paytm bank, a payments bank. And finally, in 2018, it added Paytm money for investing and wealth management. And finally, in 2019, it introduced Paytm for business. So every year, a new product or a new service. And if you look at its financial history, you can see both the strengths and weaknesses of Paytm. So if you take a look at the number of users and user transactions on Paytm, it's climbed. In fact, I've listed out over the last 5 years the number of users, user transactions, and the the rupee value of these transactions in billions. So if you look at just those 3 columns, you can see a company that's growing incredibly fast. You're saying, what's the downside? Well, if you look at the next few columns, you see where Paytm has kind of come up short. First is the revenues after climbing in 2018 have kind of leveled off. So even though the users are climbing, user transactions are climbing, gross merchandising value is climbing, revenues haven't climbed proportionately. And of course, the company is a money-losing machine. It's lost money using whatever definition of operating income that you get. And what you see there essentially is a money-losing company with revenues that are stagnant. Now, the last column, I've computed what's called the take rate. What's the take rate? It's revenues as a percentage of your gross merchandising value. For payment processing companies, this is a big deal because it's only your slice, and it's not even a slice, it's a sliver of your gross merchandising value that becomes your revenues. And there you see a disquieting trend. The take rate, which used to be in excess of 2% in 2017, has come down every year down to 0.79%. So what you might say, there's an interesting story that I see in these numbers, and it's not a rosy one for the company, at least in pieces. There's some good news in this story, right? This is a growing company if you define growth in terms of users or user transactions or gross merchandise value on the platform. But if I was cynical, and I am cynical, what I see in these numbers is a company that's adding new products and services, getting new users and user transactions, and giving them away in effect for free because the revenues don't seem to be reflecting that growth. In fact, if you bring into account the fact that revenues are not growing with GMV and the company continues to lose money, I hate to say this, but the picture I see here is of a company that is kind of stuck with a management that's too focused on user count and users and not enough on business metrics. In fact, as many of you know, I'm very fond of using a corporate life cycle to describe companies. And if you ask me to describe where I would put Paytm in a corporate life cycle, it looks like an adolescent with attention deficit. Basically unable to focus on the things that matter because it's too distracted. I mean, you look at every year they add a new product or service, add users, but they forget to charge for these products or services. Now that might be harsh, and I'll come back and reassess management and I do evaluation, but that's what comes out of the numbers. Now, of course, to fund all this growth, Paytm has needed capital. It's interesting where it's gone for capital. Instead of going the traditional route of VCs and VC capital, this is a company that after an initial foray into VC capital has depended almost entirely on big companies for the capital, and not any big companies. In particular, it's been dependent on 2 companies, Alibaba and Softbank, for much of its capital. Alibaba and Ant Financial, which is Alipay, Alibaba's financial arm, have been the biggest contributors of capital to Paytm, and SoftBank has also been a big contributor. In the last couple of years, Paytm has added a couple of big names, but they haven't contributed big chunks of capital, Berkshire Hathaway and T. Rowe Price. So this is a company that has got the bulk of its capital from Alibaba and SoftBank. And if you look at its shareholding structure, it shows. In fact, by the time the company goes public, Vijay Sharma, the founder, is no longer the lead shareholder. He owns only 15%. In fact, if you add together Ant Group, Alibaba, and Saif, Saif is a Hong Kong-based private equity firm, you get more than 50% of the shares held by Chinese companies or investors, with SoftBank being the next biggest player. Now, this is neither here nor there. I'm not saying this is a negative, but this has to become part of the story you tell about Paytm going forward. So let's set up the story. There are 5 big drivers in Paytm's value. I'm going to list out my assumptions first and then try to back up the key ones in the next few pages. Now, clearly, the lead value driver for Paytm is whether the mobile payment market, which has grown over the last few years, will continue to grow. In 2020-2021, Paytm had gross merchandising value of 4.033 billion rupees on its platform. The mobile payments platform in India has not only been growing for the last few years, but is expected to continue to grow at exponential rates for the next 5 years, about 40% a year, fivefold. Right now, Paytm dominates that market in terms of market share, at least in person-to-merchant transactions. It does lag PhonePe and Google Pay among UPI apps, and we'll talk about that on the next page. I'm going to assume that it can maintain its market share of at least the person-to-merchant market. Now, the weakness for Paytm historically has been their incapacity to convert growth in users and user transactions to revenues. They're down to 0.79% as their take rate. I expect that number to improve only marginally over the next 5 years to 1% and then double after year 5. Again, I'll come back and back this up in a couple of pages. Now, Paytm continues to lose money the way I've historically, then this whole discussion becomes moot. The company will crash and burn. But if you look at its two biggest expenses, employee costs and selling and marketing, those costs should scale down as the company gets bigger. The margin should improve. I'm going to assume a steady state margin of 30%. That may sound optimistic, but I'll explain why I've set it so high. Finally, all this growth is going to require reinvestment, and historically, Paytm's biggest reinvestments have been in acquisitions and technology. I think that'll continue to be where they reinvest money. Initially, at least for the next year, I'm going to assume they get about $3 in revenues $3 rupees in revenues for every rupee in capital invested. And I'm going to assume over time that number is going to scale down to what the peer group has, closer to 2.5 rupees per rupee invested. So let's look at the comparative landscape. Right now, if you look at the landscape, as I said, a big driver of the move towards mobile payments has been the introduction of the United Payments Interface, which is the UPI. Now, if you look at the market share of the transactions on the UPI platform, Paytm looks like a loser. In fact, PhonePe and Google Pay dominate this market. Paytm is only 11%. Now, that doesn't look good. But there are two things you need to factor in. One is, a big chunk of the transactions on the UPI platform are person-to-person transactions. Paytm is not a big player, doesn't want to be a big player in that part of the market. But in the person-to-merchant transactions on UPI, Paytm has a larger market share. And remember, not all person-to-merchant transactions happen on the UPI app. In fact, if you leave the UPI app, Paytm dominates the rest of the person-to-merchant payment market. It ends up with a market share of just in excess of 50%. I'm going to assume that it can maintain the dominant market share because it is, after all, the platform that both merchants and consumers recognize and feel most comfortable with right now. Now, in terms of take rates and margins, it's tough to tell because right now the take rate is awful and the margins are big negative numbers. So I looked at the peer group. What's a peer group? I expanded this peer group to look at the old players. The old players, of course, the credit card companies, Visa, MasterCard, and American Express. And they tell an interesting story. I mean, they still have big chunks of the market. Visa has about $2 trillion in gross merchandising value on its platform. It keeps only about 1.1% as a take rate. So it's a platform that's going for big revenues, settles for a lower take rate, and has margins of 64%. 64%. MasterCard, smaller GMV, 837 billion, but it keeps a larger chunk of that 1.8%. And American Express keeps an even larger chunk because it gets more card fees to supplement its revenues. I think that the American Express 4.22% is probably an outlier, but if you looked at the old guard here, Visa, MasterCard, and American Express, they keep between 1 and 2% of the gross merchandising value and revenues. And their margins that are sky high. If you look at the online players, the oldest of the online players is PayPal. Still growing, but well beyond the young company phase. It's got gross merchandising value of close to $1 billion. Its take rate is about 2.3%. In fact, the big online players have take rates between 2 and 3%. And their margins might not be as impressive as Visa, MasterCard, and American Express, but they're rising. In fact, if you look at PayPal's margins of 15%, they've been rising over the last few years, and I expect them to continue rising as the company's growth starts to level off. If you look at just Asia, the largest player, of course, is Ant Financial, one of the large investors in Paytm. And it's got 925 million users, GMV of 1.2 trillion, but its take rate is only 1.37%. Now, Ant Financial's IPO is kind of stuck, going nowhere. But you can see that as a company, its take rate is lower than the big online players in the US. The question is, where will Paytm fall? Initially, I'm going to assume it's going to follow the Ant route, partly because Ant is a big investor and it's modeled itself an Ant. And for the next 5 years, I don't think the take rate is going to improve by very much, maybe to 1% from 0.79%. I think the margins will also reflect that Ant Financial model and improve, but not to the levels you see for PayPal or the old guard. I think the margins, at least by year 5, will get to 5%. So in the near term, I see only a marginal improvement in the take rate and margins improving to positive, but not very positive. In the long term, I think the take rate for Paytm is going to continue to go beyond 1%. Now, and it might not reach PayPal levels, but I think it'll settle in around 2%, which is where I think Ant Financial will end up as well. I think the margins will continue to improve, and while they might not hit the 50 to 60% you see for Visa or MasterCard in steady state, I don't see why Paytm shouldn't earn a 30% operating margin. In fact, that's where I think PayPal is headed as well. So you can see my assumptions about take rates and margins coming from looking at the peer group. Now, if you look at the rest of the assumptions I've made on the risk front, I'm not going to reinvent the wheel. I'm going to give Paytm a cost to capital of roughly 10.43% in rupee terms, just below the median Indian company in terms of cost of capital, and that makes sense. Paytm serves a huge array of Indian businesses, and that cost of capital reflects it. The company is still a money-losing company burning through cash, and that would normally worry me, but there are two things that I think keep the failure risk low. One is it's got Alibaba and Softbank as investors, and they have too much to lose by letting it go under, so they will provide more capital. And the other is this company plans to raise a lot of cash in its offering that should cover its cash needs, at least in the near term. Now, in fact, to elaborate on what it plans to do, if you look at Paytm's prospectus, they're proposing to raise about 166,000 million rupees in the offering. Half of it is going to be cashed out by existing owners, so it doesn't count, but the other half is going to stay in the company as a cash balance and also push up the share count. So I think we have all the pieces in place to bring the story together, and here I valued Paytm. So let me summarize the assumptions. The big driver of value is going to continue to be the growing mobile market. You see that in the GMV over time, where it's going to increase fivefold over the next 5 years, and then the growth is going to scale down to a more manageable 4% in steady state. The take rate is going to improve only marginally over the next 5 years from 0.79 to 1%, but then double over the following 5 to 2%. Operating margin, again, gradual improvement over the next 5 years to 5%, and then increase fairly strongly after year 5 as the company settles into 30%. The tax rate, once the company starts to pay taxes, will be the Indian tax rate of 25%. For initially, I'm going to give them the benefit of being able to live off past reinvestment and get more revenues, 3 rupees of revenues for every rupee invested for next year. But over time, I expect that number to drop to about 2.5. Incidentally, that's where PayPal has been for the last 5 years. And if you look across the sector, in this case business service, it's about 2.45. So I'm going to assume that that's going to end up being the 2.45 rupees per every rupee of capital invested. Now, in terms of cost of capital, initially I started 10.44%, but over time I expect that number to decrease as the company becomes mature and its growth starts to level off. With those assumptions in place, I value the company. Not surprisingly, as the operating income improves and the reinvestment drops off, the free cash flows, which are negative for the next 7 years. So if you invest in this company, walk in with open eyes. This is a company that's going to burn through cash, but just as a qualifier, remember they will have a huge amount of cash on hand right after the offering that will allow them to cover their reinvestment needs at least for the next 3, 4, maybe even 5 years. And then the cash flows start to improve as growth levels off. If you discount all these cash flows back to the present, you add the cash, you subtract our debt, you put in the IPO proceeds, in this case the 83,000 million rupees that they will be able to keep in the firm, the value of equity you get is about 1.456 trillion. Now you subtract out the value of equity options, you divide by the number of shares, and that includes the new shares that we'll have to issue at the IPO. The value per share I get is about 2,200 rupees per share. Now, if those of you thinking in dollar terms, that's, I've essentially given this company a $19 billion value. Incidentally, staying on this $19 billion value for a company that has tiny revenues, is losing money. So next time you hear somebody say that in a DCF you cannot give a company credit for promise and potential, that's all there is in this company. It's all promise and potential, and I'm giving it a $19 billion value. Now, clearly, are there operating risks? Absolutely. Now, their operating risk can take the form of the mobile payment market not growing as fast as expected. The competition, remember, you have some deep-pocketed competitors here, and Google and Amazon coming at you, and it's entirely possible your market share could dissipate. My bigger worry is an execution risk. As I said, this company's history reflects a management that's really good at building up user count, but not very good at the business side of things, of converting that user count into revenues and operating income. And I'm assuming that that will change. Now, what could cause it to change? Perhaps, and this might be the optimistic way of looking at it, is that the management has played the game that its investors, in this case SoftBank and Alibaba, have asked it to play. And now that they're a public company, maybe they can start to think for themselves and be able to take actions that convert those users into revenues and profits, because that's what the story assumes. Now, could I be wrong? Absolutely. And one of the mechanisms to look at how wrong I am, of course, is to put in distributions for my big assumptions. In this case, I've taken 4 big assumptions. One is on the size, the growth of the mobile market in India, where I let the growth rate vary from what my base assumption is to higher or lower numbers. So, because that's a big driver of value. The second is the take rate. As I said, that's the weakest link in Paytm's business model. I've assumed an improvement over time to 2%, but maybe I'm being over optimistic. Maybe it'll stay stuck at 1%. Or maybe I'm being too pessimistic. Maybe it could be as high as 3%, which is where Square is. As for the margin, I've used a 30% assumption, and again, I could be wrong. Maybe the margin in Indian setting will be much lower, 10, 15%, or maybe I'm underestimating the economies of scale. And finally, in the reinvestment assumption, the number I've used is 2.5 rupees per rupee of revenues for every rupee invested. Maybe again, I could be wrong on that assumption. It could be lower or higher depending on how Paytm goes after new users. Now, with those assumptions as distributions, I ran 100,000 simulations. Let me summarize what I found. In about 3% of the simulations, incidentally, I did also link together my take rate and my operating margin assumptions, where I said if I get a higher take rate, it's much more likely that I will also get a higher margin. So that's what the correlation allows me to do, is tie those assumptions. But across the 100,000 simulations, in about 3% of the time, I got a negative value. Let's be very clear, this company might get a huge market cap at its IPO, but there's still a chance its value is it's worth nothing. But it's only 3%. The median value that I got across the 100,000 simulations was about 1,246 billion, and that's a little lower than my DCF value, 1,456 billion. And does that surprise me? No, because you have some outliers. There's a chance that this company could be worth this. In fact, my highest value is 8,020 billion. So there is a chance, and that is pulling my average out. So think of that as the optionality. There's a chance that this company could be a 10-bagger, and it's in that value. And I think it's more reasonable to look at the 10th and the 90th percentile, and you can see there's a huge range in value. Now, the way I read this graph, and there are a couple of interesting implications. One is, it should come as no surprise when all of your value comes from the future, and there's a lot of uncertainty and disagreement about what that future will look like in terms of how big the mobile market will be, what the market share will be, what the take rate will be, what the margins will be, that there's a big spread in value. That's kind of a given. But it also means that when somebody comes up with a very different value for Paytm than I do, I'm not going to call them wrong. I have my story, they have a different story. Now, it's also quite clear that if you are biased, if you have strong priors in this company, if you really want to have Paytm in your portfolio, you're going to find a way to get there by playing with the inputs. It's a given. And finally, I know there are some investors who believe in concentrated portfolios. That's fine. You want to own 3, 4, or 5 stocks, just don't make one of them Paytm. This is not the kind of company you should have in a concentrated portfolio, because there are so many things you don't control. If I buy Paytm, I want to make sure it's 5%, maybe 3% of my portfolio, not 20 or 25 or 40%. That's playing Russian roulette with your portfolio. So here are my closing thoughts. As human beings, we always want to group companies. In the 1980s, when tech companies first came out, tech companies became a grouping. And all tech companies were viewed as high growth, high risk companies. And that might have worked in the 1980s. By the time you get to 2020, when tech companies are the biggest segment of the market, 30% of the overall market, and they're very diverse. I mean, among tech companies, you have cash cows and you have growth companies. I think it's very dangerous to think of tech companies as a collective group. So I've heard people call Paytm a tech company, but that kind of misses the point. Could it be a fintech company? Well, fintech covers a wide array of different businesses. It is a payment processing company. It's an online company. And to show you the contrast, both Zomato and Paytm are taking advantage of the fact that Indians have smartphones and are using them. But think of how different their business models are. Zomato gets about a 20 to 25% slice of every rupee spent on its platform. Paytm gets less than 1%. Paytm's overall market is bigger, but it gets a sliver of those revenues. So if I were investing in Zomato, my concern might be, can I grow revenues? And can I grow my gross merchandising value? In the case of Paytm, I'm much more interested in, can I keep my take rate improving? Because that might be a bigger driver of value. Now, all I'm saying is not all young growth companies, and even if they're in tech, are created equal. The value drivers are very different for Zomato and Paytm. And as investors, we've got to be aware of those differences. I hope you found the session useful, and I thank you very much for listening.